6-12, and I did a similar problem. I just kind of changed the numbers on it a little bit. So in this case, we're talking about a company, say in yours it's Coulter Steel, right? They have 4.2 million in assets that need to be financed. Okay, and it kind of breaks them down into temporary current assets, permanent current assets, and fixed assets. And we'll talk a little bit about the difference. Temporary current assets are increases that you need that are truly short-term, seasonal increases that you might need for inventory and accounts receivable because of Christmas or because your season's a summer season, whatever, the type of business that you might be in. Those are temporary current assets. Permanent current assets are more a reflection of steady. Okay, if you're the retailer downtown, you might certainly have some of these temporary needs, but you also probably have a pretty regular inventory level, that typically is in the, whatever, let's say $100,000 range, and your accounts receivable level is typically in the $50,000 range. Okay, it has some spikes up, but that's kind of, typically where it's at. Okay, you might finance those more on a permanent basis. Okay, and as a lender, that's fine. You'd get reports from that type of a borrower that their inventory, accounts receivables levels were staying at that level, and so you'd finance those more on a long-term basis. Okay, and then we finance our fixed assets too. In this case, we'll say that that's $800,000. Again, your numbers are different. Totaled those just because. Don't need to, but rate for a short term, I put in at 5%, and I got 7 and 7 for my long term. So really, the key to this is determining, how you're going to finance those permanent current assets. Should they be financed like a long term asset, or should they be financed like a short term asset, right? In some ways you benefit because you get a lower interest rate here, but then the math's the same as what we've done before, is our amount times our rate. We do that for each 3 of those asset classes. We total that up. This is the interest that we're going to pay. Okay. And then it asks us to take it a step further and calculate then what our net income might be. So it provides us with our EBIT, or earnings before interest and taxes, right? And it tells us that that's 100, or in your guys' case it's something different, but I'm using 180,000. Okay. My interest expense then I get from up here, and I'm just going to enter that in as a negative. So I can, one thing, here's how you link a cell if you want to. You can just use the equal. I think you can use the plus or the minus, and in this case I'm going to use a minus. I got a positive number here, but I want my interest expense to show up as a negative. Okay, so I've got my earnings before interest and taxes. I know what my interest is, so now I can calculate my interest, or my earnings before taxes, right, which is simply equal to this plus. I could sum it as well, but that, all right. Then I have to calculate what my taxes are. Okay. And in my case, in your guys' case too, it's 40% tax rate, and we take that on our earnings before taxes. So we simply say here, and I've entered that as a negative, so I'll just use my negative sign is equal to my 40% times my earnings before taxes. Okay, and here again, be careful. It'd be awful easy to want to get all of those things included like in a sum, but you don't want that. Instead, you want to just say this is equal to my earnings before taxes minus, but because it's a negative number, I've got to hit my plus this. Okay, so I end up with a net income, positive net income, $62,100. Obviously, your guys's will be way, way, way different. So let's see, where's my bottom double border? There we go. Make it look nice. All right.